Welcome to this Killick Explains video, and sorry to be a party pooper this week, but I'm going to talk about 4 factors that could unsettle stocks in 2025. Alright, it's easy to be bullish actually, particularly about the US stock market, perhaps a little bit more than the UK, but what are the things that could upset the stock market? I'm thinking of the US stock market as the biggest one in the world, but I'm thinking about other Western stock markets too. So, backdrop is what? Well, the bulls looking ahead over 2025 will say, frankly, the US stock market has had 2 bumper years, 2023, 2024. Interest rates are low-ish and sort of creeping down around the world. Technology stocks, those big giants, still look pretty strong. All right, and corporate earnings, generally speaking, are holding up well. So what's not to like? Well, I'm just going to put 4 points across in this video, 4 areas to keep an eye on, 4 things that could, in the short term at least, spoil the party. Although, of course, as a long-term investor, you won't let any of them completely derail your strategy. And those are deficits, come back to that in a moment, reduced fiscal monetary stimulus, inflation, and what's been going on in what I call private markets. So deficits first of all. Now there's no 2 ways about it. The US is running a big deficit, sort of almost a big national overdraft, if you want to see it that way. In fact, it's 5 times higher as I make this video in early 2025 than the previous high. It is rapidly building up, and that is also true in the UK and Europe. In the UK, for example, we have a chancellor with ambitious spending plans, only a certain amount of tax revenue to pull on, and that potentially adds to the overall deficit situation. And basically, the big question is, for how long can governments borrow and spend, if you like, before bond markets start getting nervous? So keep an eye on how bond markets are reacting to these deficits, both in absolute terms and the speed with which they change. In the US, bond yields, that is the amount the markets demand from governments in order to fund all this deficit activity, those have been rising. They've been dragging UK yields up too. And people talk about the bond vigilantes, which is a flash way of saying, the people that run the commercial bond markets, the big players, watch governments carefully, and they do react if they don't like what they see. So keep an eye on that one, number 1. Number 2, fiscal support. Now, for years actually, what central banks were trying to do, and certainly we saw this during the pandemic, was to sort of prop up asset prices. There was a feeling that otherwise there could be almost a global collapse, and they did that a couple of ways. Cutting interest rates was one, quantitative easing was another, which essentially is money printing, as it's loosely called, releasing extra liquidity into the markets in the hope that liquidity would find its way into asset prices. Now, those levers are to a degree being pulled back. Yes, interest rates are creeping down, but that masks the fact that all that liquidity, all that bonus cash, if you want to see it that way, from central banks, is being sucked slowly out of the system by something called quantitative tightening. Now, for those people who do not want to know the technical detail, it's just a sort of behind-the-scenes mechanism by which central banks, particularly in the US, can gradually pull liquidity out of the markets. And if they do that at the wrong speed or to the wrong extent, that can potentially hit all kinds of different asset prices. So you need to tread with care. Next, inflation. Now, a lot of people are thinking, actually, inflation is pretty much under control these days. And certainly there's some evidence of that. Supply chains around the world have recovered since the disruption caused by the pandemic, and disruptions cause shortages, shortages cause inflation, but that's kind of settling down. The oil price is a little less volatile than certainly it was a few years ago. So there are signs that inflation may be sort of under control globally, but there are things that could kick it upwards. Tariffs is one. Tariffs are generally inflationary, so watch Trump in particular. Then there's government activity. If governments invest by borrowing, all right, what they invest in can itself be inflationary. And of course, in the UK in particular, watch out for pay deals. If governments keep rewarding civil servants, public sector workers with more pay, that in itself stands to reason is inflationary because those people can then afford more stuff. Finally, private markets. Now, private markets, if you like, are not public markets. Thanks for that, Tim, but it's the part of the capital markets where money is raised off-piste, if you like, not at the London Stock Exchange, not at the New York Stock Exchange, all right, but literally in private markets. So they're thriving. I mean, they've had an amazing 5 to 10 years, if you like. In fact, more money, it's estimated, is now raised in those private markets than is raised publicly on the stock exchanges that appear in the news all the time. And there are many reasons for that. Some people think that the scrutiny of public markets distracts managers from running companies properly, and also that those private markets are a more efficient source of capital. But I won't go into the whys and wherefores. The fact is, there's a lot of money, all right, being raised and spent essentially in a market that you can't necessarily see or you won't hear about day to day. So what are the risks? I mean, that all sounds good, doesn't it, Tim? What are the risks? Well, there are people who are concerned about the debt levels in those private markets, because what a lot of these private investors do in order to invest in companies, turn them around and spin them off, is borrow heavily. So if interest rates start rising, that affects private markets as much as it does public markets. Then there's the rising number of initial public offerings, because what some of these private investors do is they'll pull a company out of the public markets, tinker around with it, reduce costs, gear it up, load it with debt, and then they'll try and sell it back into public markets via something called an IPO, an initial public offering. Now, on one level, loads of initial public offerings and activity has been picking up are a good sign. Buoyant markets and all the rest of it. But these people are not stupid. Are they offloading their assets at what they perceive to be the highest price? And if so, are they effectively calling the top of the market? All right? Because these private investors are canny. So they may be offloading some of these companies at what they perceived to be the best price in the medium term. And of course, the other problem with private markets, as a clue in the name, is they are less visible. Right? They're not subject to as much scrutiny. Regulation is lower. They're not on the London Stock Exchange. They don't have to comply with all those rules. Okay? And some people are saying, that lack of visibility could potentially be storing up problems that are only visible to the sharpest analysts. So what do you do with all this bad news? There are 4 things to watch. Doesn't sound terribly optimistic. Well, as an investor, just stay vigilant. Okay, watch for the warning signs, bond vigilantes, bond yields and so on. Keep a long-term mindset. That's always important. Expect some volatility. These factors will trigger headlines, reactions in the market. So expect a bit more volatility and make sure you stay properly diversified so that if, for example, news starts trickling out of one part of the market that these factors are not fully under control, at least it won't destabilise the whole of a purely UK-based portfolio, for argument's sake. Okay, lots of jargon in there. So if you'd like to find out a bit more about some of these topics, killick.com/resources is the place to go for other videos. My how-to guides, there's one sitting next to me, and our quarterly magazine, which normally has an equity analyst piece in it, Confidant.